Our firm always looks for the most probable outcome in every investment decision or situation. We don't base our investment decisions on wholly unlikely events, and we always look longer term. Remember, we're buying companies, not stocks. However, we also attempt to recognize potential problems when they occur, which allows us to make proper decisions on how we can take a problematic investment or a problematic economic situation and create a positive outcome for your net worth long term. So in our September 23rd, 2020 Facebook Live session, we stated that, quote, "We believe there will be a more anemic economic growth with a Biden presidency, but we also believe our portfolio performance should be exceptional." So let's go back now, let's hindsight it, and let's see how it worked out. Since November 1st, 2020 to January 20th, 2021, our clients' accounts were up 36.59% net of cost, doubling the S&P 500 index returns over the same number of days of 17.79 and the Dow Jones return of 17.68.
Your performance is very transparent to your clients.
Yes.
You're very open and accountable, accessible if you have questions. But when you're hitting those highs, it's obvious you are exploiting some highs there that you saw, not through ignorance, but through analysis and deep study what was coming. And then, so the highs are there and amazing, and then the lows, your prediction of lows, I think, is unbelievable. Would you mention what's going on there?
Yeah, I will. So, there are certain signs in the market when you reach interim lows, and I call them capitulation selling signs. The last one we saw was on March 23rd of this year. We identified that low in a letter to clients on April 2nd. And it turns out that was the low, as I had predicted, for a market cycle. Buffett is the long-term chairman and CEO of Berkshire Hathaway. Warren's work is exceptional, and he's been called the greatest investment manager of all time. But our firm has beaten Warren's returns, and that's all accounts, net of cost. And that's a record we intend to continue unless Warren retires after me, which the way he's going, he might.
In the COVID-19 crisis, which I believe is a glitch event, our firm played smart, ignored the useless fear-based media and brokerage firm chatter, and relied on long-term lessons through economic history and our own unique knowledge of the markets. And the result? We've regrown your capital. Our firm does not sell in glitch events because historically they are repeatedly self-correcting. We will sell in recessions which do not tend to be V-shaped quick recoveries like the glitch event. The best example of this was our action in the recent 2008 to 2009 recession, one of the worst our country's ever had, when we fled to cash with approximately 75% of our clients' monies, avoiding a very large part of the 2008 decline. We then reinvested on the day of the market's 2009 low, a day we called in a letter to all of our clients, and provided on average our clients' net return of 46.82% in the year of 2009, more than twice the S&P 500 return. We think it's our firm's investment patience. We think it's due to our firm's concentrated, predictive, and active, not passive, asset management style. In our view, long-term investment success has always involved calculated investment selection, patient investment, staying true to an investment discipline over market cycles, in other words, not changing horses in midstream, and an understanding that temporary declines will end as soon as politicians decide to open businesses back up. In other words, if you choose to close the door to the economy, to business, stocks will always decline. But when you open up, things are likely to go to the same or higher pricing level than there were previously.
And we are a predictive style. And so we're looking forward because there are no rear view mirrors in jets, are there? You don't have mirrors.
Let's see. Rear view mirror, yeah. Yeah. So yeah, and you're talking active management, right?
Yes.
Because passive management is, buy and hold, put it on autopilot, right?
Yes.
Just let it ride and hope you hit something good, right?
That's true. Tom, if you think about it, if you put it on autopilot, just leave it there, eventually the engines are going to flame out. One of the tools we've invested in the last 11 and a half years is Morningstar Inc. And Morningstar assesses our clients' returns so that what we're presenting is fairly presented and is an exact depiction of what we've actually accomplished. We've also purchased data from Dalbar Inc., which is another very large econometric firm. And what Dalbar shows is what we see consistently from accounts coming into our firm from other service providers, and that is a level of mediocrity that equates to roughly half of our long-term returns. We believe that performance matters. We believe that financial planning truly makes a difference in the lives of our clients, and our recommendations are made on that basis. And we advertise that we are a concentrated and predictive style. That means that it's relatively common that we might have 10% of a client's assets invested in one company, because we're going to buy what we believe and know has the best current valuation and the most upside for our clients with adequate safety margins. We believe that gives our clients the best chance to perform adequately or outperform the markets. And we're going to continue to do that because it works.